There are around 5,000 ISA millionaires in the UK, with the average time to get there around 22 years. And in this video, I'm going to show you a few key principles that can help you to maximize your ISA growth. So hopefully one day you can be part of that elusive club. The first thing that may shock you is how much quicker it is to get there than you may expect. With the annual ISA allowance at £20,000 per year, to get to $1 million, you may think that might take 50 years to get there. But with compound interest, it's actually substantially less than that. Let's have a look at a few examples using historical data. First, we're going to take the performance for the FTSE All-World Index over the last 20 years. And this has a compound annual growth rate of just over 10%. And what we're going to do for these examples, because they're fairly long-term, we want to build in a little bit of a buffer for inflation. So what I'm going to do with each of the percentages that we use is just take 3% off for inflation. So then when we're looking 20, 30, 40 years in the future, we can have a little bit more confidence that we have adjusted for inflation. Just for this example, let's assume that we can invest the full amount into the ISA, which is £20,000 per year. That works out at £1,666 per month. We take the 10% that the FTSE All-World Index has grown per year, and we take off that 3%. That gives us an annual growth rate of 7%. If you were to stay invested through the whole period, after 21.5 years, you would have a future investment value of just over £1 million. Now let's have a look at what that would look like if we use the S&P 500 instead of the FTSE All-World Index. Now over the last 20 years, the S&P 500 has returned on average 12.3%. If we take off our 3% for inflation, that gives us an annual growth rate of 9.3%. Assuming exactly the same variables, we would now reach the same investment value after 18 years and 8 months. That's a saving of just under 3 years. Now just for a bit of fun, let's just assume that we were invested in the S&P 500 over the last 10 years, which has well outperformed its long-term average. Over the past 10 years, the S&P 500 has returned 16.3%. This is when your investment is denominated in GBP. Again, we take off our 3% for inflation, which gives us a compound growth rate of 13.3%. We're going to reach that future investment value of just over £1 million after just over 15 years, a saving from the previous example of just over 3 years. Of course, all of these are hypothetical and there's no guarantee that you would get that return long term, and especially for the S&P 500 over the last 10 years, that has been exceptional. But there's nothing to say it can't continue as well. But it was just to give you an idea of a few different performance points. It also assumes that you can invest the full amount into the ISA. I think that goes without saying that the more you can put in, the quicker it's going to be. And also that you need to remain consistent throughout. The key with investing with a goal like this is that you have to have that long-term approach. You have to be willing to sit through all those downturns, all the bad weeks and the bad months, knowing that over the long run, you're going to have a really good return. That also means you need to have the short term covered as well. So that means having a good emergency fund and also ensure that you've paid off all your high interest debt before you invest into the stock market. Because the last thing you want to do is having to sell an investment at potentially a bad time just to pay off some debt, or because you didn't have an emergency fund because the car broke down or the boiler broke and you need to replace it. So make sure you've got the short term covered before you start looking into that long term. A general rule for investing, especially for the long term, involves being consistent with your deposits. So because most people get paid on a monthly basis and people might do a budget at the same time, it's likely that you're going to set up an automated direct debit that you can invest into your investment platform long term. But actually, with our goal of wanting to grow this as quick as possible, if we're able to, would actually be more beneficial of investing as early as possible. So when the tax year comes around in April, the more you can put in at the start of the tax year, the more advantageous it's going to be. Because we know over the long run the stock market is likely to go up, the sooner we can get that money into the market, the better. Of course, I know it's unlikely you're suddenly going to have £20,000 to invest in every April, and it's likely you're more likely to spread it out. But the more you can weight it towards the first part of the tax year, the better you're going to be in the long run. In terms of what to invest in, the FTSE All-World Index or the S&P 500 would be great choices to invest in for the long run. You can just sit back and let them do their thing. You don't need to worry about timing the market. You just invest regularly and they'll do the rest for you. There is potential to get better returns than what we've already discussed by going down a little bit more of an active approach. That could be investing into single stocks yourself. It could be using an active fund manager. But the historical data shows us that actually going down a more active approach, you're more likely to get a lower return than you would have done just investing into an ETF that tracks the stock market. If you do want to go down a slightly active route, you could have a bit of a split portfolio. So you could have 80% of your portfolio invested into passive funds, and then maybe have 20% of your portfolio investing into the active fund market. An interesting thing to look at when we compare active to passive funds is actually how different regions have a different probability of beating that market over the long run. So as you can see from the data here, if you were to invest into an active fund that is looking to get a return in the North American market, over the last 10 years, only 15% of active mutual funds have actually beaten their benchmarks. If we compare that to global emerging markets, 56% of those funds have beaten the benchmark. So if you are looking to have an active element of your portfolio and you're looking at active mutual funds, then actually looking at some of the slightly smaller regions and some of the slightly less efficient markets, such as the emerging markets, could put you in a better stead than investing some of the bigger markets like the USA. When you invest into the stock market, you're also going to have a decision to make of what to do with the dividends. Most funds will have two different options, either accumulation or a distributing or income version. This just refers to whether the dividends are going to be reinvested back into the fund or whether you want them paid out. Of course, because we're going after the growth, we want to make sure those dividends are being reinvested and boosting that value of our portfolio. So you want to look for the accumulation version of any fund that you pick. But any investments you make into it, you've got to make sure you have that long-term approach. You've got to see it exactly like you do with your pension. It's not something you're going to be checking every day. And that's why you might lean more towards a passive approach, because the more active you go, the more you might have to spend time tinkering with it or just monitoring it in general. So the more hands-off you can be and the less attached you're going to be to certain news events and any downturns, the better you're going to be in the long run. And my final tip for you is start as early as you can. Even if it's only £50 or £100 per month, as long as you've got the short-term covered, start putting it into the stock market. The longer you can stay invested for, the better your return is going to be long term. And never think it's too late to start. The average age for an ISA millionaire in the UK is around 70 years old. And looking at some of the returns that we've discussed in this video, it could take you a lot quicker than you might expect. And then from a retirement perspective, any growth and any dividends or income you get from the ISA is completely tax-free. Let me know what your strategy is for growth within an ISA. And if there's anything that I may have missed in this video, then please let me know down below in the comments. Thanks for watching, guys. I will catch you in the next one.